Hi, folks. Thank you for joining. My name is Chris. I'm with EBS Associates, host of this event, and thank you again for joining us today. I would like to introduce you to Mike. He is with Finagraph. I'll let Mike explain a little bit more about himself because he could probably do a better job than me. So, Mike, go ahead and take it over.
Chris, I'm ready. All right. Hey, we've got 6 weeks together, folks. I got to tell you, if you've never heard me speak, if you've never heard what we're going to do, I live and breathe cash flow. My whole mission is to keep your business in business. All right, that's exactly what I'm trying to do. A little bit about myself. I am the Vice President of Customer Success for Finagraph. Finagraph is a banking company, banking software, but we provide software to both lenders and to small business owners. We do that usually, including the accountant. So what we're trying to do is triangulate the accountant, the banker, and the business owner, so we're all speaking the same language, and the business owner can get more money, right? I mean, and be more profitable. What we're doing is I've taken a one-day seminar that I do about 30 times across the country per year, and I've broken it up into about 6 different hour sessions. So we're gonna kind of walk through what a one-day seminar would look like if we went from 8 o'clock in the morning till 5, and then we're going to break it up into pieces. But what we're going to focus on is the things that make you successful, right? If you don't know how to analyze your business, if you don't know how to work on your business instead of just in your business, I'm going to give you some tools. And every day you're going to have something that you can employ that day. So, I mean, think about that. I mean, every hour you get off the webinar, you're going to have a new tool, a new strategy, a new idea that you can employ right there. About me and why you should listen to me, I guess. Finagraph is the 10th company I've either built or helped build. So I've built everything from hotel staffing companies to restaurants to real estate management companies to now software. And believe it or not, I have a messy resume because of that. I mean, it's a whole breadth. I've done everything from retail through service industries, and I'm an MBA at a Baylor, but that wasn't my first job. And so my first job was I was a state trooper. So if you see those type of references come in, from me being a state trooper, that's where it comes from, right? My first job right out of it. So I'm going to use a lot of stories. The way I teach is through a lot of stories because I think it helps you understand. I never know how people learn, right? I just never know how they learn or what sticks. So you'll see me use a combination of, things that are visual, things that are audio, just stories that I tell. We'll do written exercises together. I may ask for input from you. So let's just kind of talk about some admin type things. Because this is a webinar, it's a little bit different than if I have 30 to 50 people sitting in a classroom. So I'm going to ask Chris to watch the question box. If you have a question, kind of get Chris's attention. He'll unmute you. You can ask the question. It's okay to interrupt. That doesn't bother me a bit. It's just I don't watch the question box as much. But I do want to be able to answer your questions and make sure we keep everybody on the same pace. I don't want to get too far ahead. I don't want to lean too far forward. I want to make sure that we all kind of move forward together as this works. So that's a little bit about me anyway. Looks like we have a number of people that are on with us. I think it's going to be a good series. I think we're recording it so people that miss it will be able to come back to it at a future date. Even if you miss something, you say, you know what, I want to go back and review some of the topics that we just talked about. You'll be able to come back and review it. So because I'm an ex-state trooper, let me put together some ground rules, some rules about how we're going to interact together. And I'm just going to write them on here. So the first one is that you can copy. You can copy, which means everything I've got here, just copy it. Just print it off, just copy it. It's copywritten, but in my mind, that means, hey, copy it right. I spent a lot of time putting this thing together. Copy it right. Don't screw it up. Don't try to change it. Just use it as is. But you can copy anything that we have here and use it over and over and over again. The other thing is you can cheat. You can cheat. See, I'm not like a typical professor, right? I'm not like a typical professor. But when I talk about cheating, to some of you, this might not be new. You might have been doing that a long time, but we don't call it cheating anymore. We call it best practices or cooperative learning. But we're going to be able to do that. I am an instructor at 3 of the top banking schools in the country, masters in banking, at LSU, Colorado, and at the University of Washington, Pacific Coast Banking School. And because of that, I try to make things simpler, right? A typical professor takes a simple concept and makes it more complex. We don't do that. We're going to roll it back just a little bit. We're going to take complex ideas and make them more simple for the rest of us to be able to understand. So when I looked at the attendee list, it looked like a lot of us are business owners. So think about that. I'm just like you, right? I've fought the same battles. I've walked the same line. And the tools that we're developing for business owners are for people like you and me. If you haven't seen our new product, I suggest you go get it. 14 days free, or ask Chris over at EBS about it. They've got great specials, on what it is. So go ahead and sign up for it. It's cashflowtool.com. So if you're interested in cash flow, that's going to be my big sales pitch. You're not going to see a big sales pitch for the next 6 hours. But cashflowtool.com is the newest product that we've developed, and it forecasts. It uses our artificial intelligence. It uses machine learning, and it analyzes your previous behavior to forecast what's going to happen next. It works right with QuickBooks. So any of you guys use QuickBooks, just add it right over the top. It analyzes your QuickBooks transactions and tells you what to expect. Even if you can't make payroll 2 weeks from now, we're going to be able to forecast that out. We're looking at about 60 days in advance. So helping you see things before they become a problem. So that's 2 of the rules. The next one is, hey, I would just call it talk. But in this case, because we're on a webinar, let's just, you guys can chime in. You can ask me questions. Don't be afraid, right? Like I said, I want to go step by step. I want to make sure that we're all doing about the same things at about the same times. So copy, cheat, talk. Talk means just ask the question, and don't let me go too far past it, so I can make sure that we're all on the same page. It's okay to guess, right? I may ask for some input, and just you type it into the question or chat box, and we can talk about different things, or I'll even unmute you and let you speak to the group. If you got a good story that you want to share, we can do that as well. So good. Here's what we're trying to accomplish. We're trying to make your business more successful, right? That's really what we're trying to do. We're trying to make it more successful, and we do that through education. So let me just kind of get going. I'm going to bypass the outline, but the way I teach is the use of a couple different tools and through a case study. I was consulting after I sold my company in 2011. I did some consulting, and I used that as a model for building this course, just because everything that happened was so relevant and so normal, right? Everything was just normal. I'm like, oh, this is the perfect case to share with others. So we'll do that. If you look in your outlines, if you look in your slide decks, you're going to see 3 different things. You might want to print these out or set them to the side, or even just label your pieces of paper up next to you what these are. But there's success principles, there's watch its, and then there's a bar napkin. All right, so bar napkin. Let me tell you what those are. All right, in a success principle, throughout the course, right, throughout the next 6 weeks, I'll say things like a successful business owner does X, or a successful business owner does Y, and then I'll explain what that is, right? So what that means is at the end of the course, you'll have a little list of just nuggets about what successful business owners do, right? So for instance, the first one I'll give you is successful business owners start with the end in mind, right? Successful business owners start with the end in mind. And I'm going to explain what that means as soon as I get the admin stuff out of the way. So if you want to shorten it up, SBOs start with the end in mind. That's your first success principle. All right. When we get to like watch it, if we would have known in 2007 what was going to happen in 8, 10 through almost 15, 16, we would have done things differently, right? I mean, there were several little indicators that the real estate bubble was going to pop, that the economy was going to be into a recession. And most of us, if we would have had the same foresight then that we do now, we would have actually, went to cash in our investments and held on to the cash. Some people will say if they're swimming at the deep end of the financial pool, well, I would have shorted the market. I don't think most of us that run businesses, small businesses anyway, know how to short the market. Maybe you do. If you are, you're swimming at the deep end of the pool. For guys like me, I would have just went to cash and sat on it and waited. Right? I didn't do that, so I took the hit like everyone else. So anyway, that's a watch it. I'm going to show you little things that may not be a problem today, but if you keep seeing them pop up, they're an indicator that a problem is going to happen in the future. So that's why we call them watch-its. After that is the bar napkin, and I blame this on my dad, and not because he was a drinker, not because he sat all the time in a bar, but he had the uncanny ability to take a complex idea, something that he didn't know about. He was a truck driver in Illinois, but something maybe I didn't think he knew about, and he could take the back of a napkin, the back of an envelope, a piece of paper, anything, and sketch out a diagram, sketch out an idea in a matter of seconds that helped me understand a more complex idea or complex concept. Like fracking. I learned about fracking from my dad. He was a truck driver and had no business knowing what fracking is, but he was able to draw a diagram of how they do it, why it's important, and all those things, at least in his mind. That's what he thought. So bar napkin, we're going to use those throughout. You don't need to label something bar napkin. Just know that I'm going to do a diagram or give you a short little tool to be able to help you throughout the whole course. All right, so we're going to try to keep this about an hour, right at about an hour today. And that way we can all kind of, keep our schedules and understand what's happening next. So here's what I want you to do. Give me just an indication that you're ready, right? I don't care if we raise a hand or just say, I just want to make sure that people out there and are listening still, you can put it right in the chat box and say, hey, I'm ready. And I get a couple of those and I'll be ready to go. If you haven't done so already, you might need, hey, all right, there we go, there's one. If you haven't done so already, we're going to be using an HP 12C calculator. You don't have to have one. I'm just going to show you a technique of how you get this thing started. So anyway, if you want to do that, if you don't have one already, I think we send out a link for a free version. You don't have to have this, but I'm going to teach you how to kind of use it to be able to figure out some things. All right. So let me get back to the program. When I said successful business owners start with the end in mind, here's what I'm talking about. We're talking about the biggest concern of the business estate planning is, hey, will I have enough money at the end? When I want to retire, is there going to be enough? Can I do what I want to do? And really what that means is that's what transferable value is, right? Do I have enough money to do whatever it is I want to do next? Do I have enough money to do that? So that's one of the biggest concerns. How to do it, and then will I have enough money if I do it? We all want to do, something at the end. So I think it's transferable value, and that's my second success principle. My second success principle is to start. First one is to start with the end in mind. Is to successful business owners know they should build transferable value. Successful business owners know they should be building transferable value. Transferable value is the amount of money that you need to do whatever it is you want to do next. To some of us, if we retire or want to leave our businesses, it may be that we want to sit on the deck, on the back of our house. We want to watch the sun go up and drink coffee. We want to watch the sun go down and drink wine, right? That could be our dream. Others might have the dream where when they leave their business, they want to take 6 months and travel the world, and then maybe every year go to a different country for a month. It takes a different amount of money to achieve both of those dreams. To sit on the deck takes a little bit of money. To travel the world takes a little bit more money. So we're going to talk about what is your transferable value? What is that number we're working towards in order to do that? So then we're going to help you define the end. How do I get there? Oh, and then options for a happy ending. Those are all the things we'll talk about in this webinar. So here's some of the biggest concerns that I see, right? There's a lack of liquidity, meaning, hey, I've got this business, but I can't sell it. I don't know what to do with it. It's just things that are there everything's tied up. All my money's tied up. Liquidity is nothing more than cash. Can I spend it? If on my blog, cashflowio.com, cashflowio, like in-out.com, I just wrote an article on liquidity, and I took the balance sheet and broke it down into water, slush, and ice. And really what you're doing is saying, how difficult is it to convert an asset to cash? Cash is the liquid. AR, inventory, you can convert it to cash, but it takes a little bit of time and effort. It's slush. Your fixed assets are more frozen, so it takes a lot more time or a lot more effort to convert fixed assets to to the actual water or to the liquid. There's no transition plan. People don't wait, or they usually wait until the last minute. So the transition is a failure. They usually have business owners usually have most of their investment tied up in their business, and they don't have any other type of diversity. And then most people don't know how to value the business. They think it's worth more than it really is. And you don't want to get to the end where you think you're walking out the door and be surprised. I actually worked with a client that thought their company was worth about $12 million, and during the valuation, it came back at $3 million. We don't want you to be surprised by what the value of your company is. So I'm going to give you, in these 6 weeks, a couple of different ways to do your own valuation to keep up on that. And I would say, hey, reevaluate your business every single year, right? So you know where you're at, if you're on track. So by starting with the end in mind, our first success principle, we're going to be able to plan for the unplanned, control how we transfer, and then maximize our business value. When I talk about building transferable value, this is kind of what it looks like. This is how it starts, right? It starts with a value proposition. That's kind of, what is it that, you have to offer, right? Then you have your competitive advantage. Why should I buy it from you? You add those two things to marketing, which creates your brand. Then you worry about the box. This is where all the money is made, this box. This is where people see risk. This is where if you have a bad company, it shows right there, right? That's where it's going to show. If you have a bad company, this is the box that reduces your value. So we're going to spend a little bit of time on there over the next 6 weeks, because this is also the box that builds goodwill. And goodwill is the amount of money that somebody will pay you for your company over and above the value of the assets, which means if I can go out there and buy all the equipment, get into the business myself, why would I buy your company? Well, it's because you've already solved for the product, the process, and the people, and it has potential and it's generating profits. You've already done all the work. You get paid the goodwill for it. What we're trying to do, though, is determine right here. I'm at the closing table, and I've seen it. I bought 5 companies and sold 3. What you see when you get to the closing table, and you don't want to be this guy, is that you get the check and you look across the table at the other person and says, oh my, that's not going to be enough. Your blood, your sweat, your tears, everything you've done for your whole life in this business, it comes down to that moment. And when you realize that I did not build transferable value, I built a job. That's when you look at the check and say, it's not enough to do what I want to do next. I need to go find another job. So we don't want to lose sight of, we want you to be able to walk out your business into whatever next life you want and not have to worry about getting another job. So that's what I'm here to do, is kind of help you put that together. So let's kind of break some of these down. How do we know what our transferable value number is, right? How do we know what that is? First of all, you're going to take, and this is just a rule of thumb, you can use your certified financial planner to come up with a better number. This is how to get started. If you want to do something tonight, right, this is how you get started. You're going to take the amount of money you think it's going to take you to live and multiply that by 25, because most of us, that average age of life post-retirement is about 25 years. Whatever number it is you think it's going to take you to live, multiply that by 25. If you think it's $100,000, if you say, hey, my lifestyle I want to live is $100K times 25 equals $2.5 million. That would be the number. That's our transferable value number, $2.5 million. So if I think about that, if I think about $2.5 million, I also have to say, oh, I have $500,000 already in the bank. That means over the next however many years, I need to accumulate $2 million more, and I'll be happy. So if I already have $500,000 in the bank, I need $2 million more. If we have 10 years to do it, that's where we start breaking it up in chunks. I break my $2 million into 10 years, and I need about $200,000 a year to be able to get there. So that's kind of what we're doing. So your business has to be able to generate that, or you've got to be able to get, a combination of profits plus selling your business. You don't want to rely on just selling your business. I like to call that the gravy. Whatever you get is just over the top. We're going to try to build a plan to put the cash in your coffers all the time. So whatever it takes for you to live times 25, that's the number we're going to work towards. All right, so when you're building your plan, when you're using some of the strategies that I say, that's how we're going to do it. Okay, here's how we set it in motion. I use an HP 12C calculator. I use that to calculate it. And you'll see when we do net present value on here, I'm really looking at this box. That's all I'm worried about. You've got the number of periods that we have. You've got the interest rate, and I usually am real conservative on what I'll think I'll gain as interest. You got your present value, which is what you have right now. Your payment is what you're going to have to put aside every year. And then your future value, what are we working towards? This CHS means change signs. So when we put money in, we actually have to make that a negative when we're putting money in. And that's just the way the calculator makes it correct. So we change it from a positive number to a negative number. And I'll go through a couple of examples here. Again, if you don't have this calculator, it's okay. There's lots of other calculators out there that will help you do this. But what we're trying to do is figure out how much we need to put aside, each year in order to reach our goal. So here's a couple of examples I want to look at. And I'm going to write these down because I'm going to pull up the calculator. So in the first example, this is just talking about getting to our transferable value number. It says, looking at, my income needs, I'm going to need $2 million to retire. I'm 45 years old. I want to retire at 65. I think I can earn 6% a year. How much do I got to save to get there? All right. So that's basically what we're talking about. So let me write those down real quick. I got $2 million as the future value. That'd be your FV. You've got 6% is your interest. All right. Interest I is 6%. Then you've got 20 years to do it. That's your N. And we're starting from zero, right? We're going to start from zero. So our present value, our PV, is zero. If you notice, I don't have the payment. Payment, when you use a calculator like this, whatever you leave blank is what it will solve for. So let me pull up my my actual 12C calculator and see if we can get this done. All right. So I'm going to put in the first piece of information, which is our future value. So I've got 2 million. 200 maybe 002 1 2 3 $2 million, and I'm going to call that my future value. Then I'm going to put in my interest rate of 6. That's our interest rate. Okay. Then I'm going to put in our 20 years. I have 20 years to do it. 20 is 0. I have a payment, or not a payment, a present value, 0. Always change signs on that. Let's see if we can do that. 0, present value. And we're calculating for payment. So if I press payment, it should tell me that I need $54,000 per year in order to reach that goal. So $54,369. If I go back, that's what I would say. If we're building our plan, we've got 20 years to do it. I've got to set aside $54,000 a year. If you take that, divide it by 12, we're going to divide that by 12 just to see what happens. I think we can do it here. Divide it by 12. Let me do it. No. Well, let me do that one because I'm already in the present value thing. So let me go ahead and clear. But just know that divide your 54 by 12. That should be your monthly profit goal that you're going to set aside. Let me go through it again. We had $2 million in our future value. That's where we want to go to. $2 million future value. And I had 6% interest. And I had 20 years to do it. Okay, I'm starting with a 0 present value. And I want the payment, $54,000. So that's what we would start to work towards every year in order to reach our $2 million. So that's how we would do that. Okay. How about one more, just for safekeeping? This time we are not starting at 0. We're starting with $400,000. All right. So we got $400,000 in savings already. We still want $2 million. We still want to do it in 20 years. we're still going to get 6% interest. So now how much would we have to save in order to make that happen? So our present value changes from 0 to 400,000. Go ahead and clear it. I'll put in 2 million. 2 million is my future value. I now have a present value of 400,000. Change sign. Present value. I changed the sign because it's money already gone. It's money already set aside. Okay, we've got 6 as our interest rate. And then we have 20 years to do it. And our payment under this category would be $19,000, right? So we want to set aside $19,500 per year. Again, all we're doing here is determining how much it will take to live the lifestyle we want to live when we walk out of the company, right? So that's what we use the HP 12C for. So in the first case, it was you want to say 55,000, and down here we'll just say 20,000 to be safe, right? And then we would divide those by 12 and make sure we're setting those aside every month. Okay, there it is, 54 and 19. Oh, I already had it calculated. Yeah, look at that. I guess I've done this before. So setting aside 45. Now this is the moment of truth. When you see those two numbers, 45 or 16 is the number you come up with, you got to ask yourself, can my business generate that? If it can't, then either we've got to adjust our lifestyle or we got to figure out a way to get our business to grow to get there. So that's kind of that moment of truth to make sure that your dream is either realistic or not. That's what we're looking for. Okay. So how do you guarantee that happy ending? Hey, first of all, you got to know how much we're working towards, calculate the amount per year, reevaluate your progress annually, and then recalculate if you need, and then, hey, then retire. That way we just sell your business. It's just going to be gravy. Now, here's the next successful business owner step I've got for you. A successful business owner, a success principle, successful business owner should run their company today as if they intend to sell it, right? Even if they're not going to. Run your business as if you intend to sell it, even if you're not going to. Because what you'll get is the benefit of a well-run company. If you've ever sold a car, like on the open market, put a for sale sign right in the windshield, you put the for sale sign there, the first thing we usually do is we go clean the car. We go clean it up. We kind of fix all the little things that need to be fixed. We get the French fries out from underneath the seat. And what we do is we have a nice car now. And if you're like me, as soon as I clean it and I fix up some of the little stuff that I thought was quirky, I actually drive to work and say, man, this is a nice car. Somebody's going to get a good deal here, and then I kind of reevaluate, do I need to sell it? It's the same thing with your business. If you act like you're going to have to show that business, or like you have to show your house and it looks good and it looks immaculate and it's doing the things that it should, you get the benefit of a well-run business the entire time, that it's happening. You get the benefit of it the entire time while it's happening. So that means you get the profit. That means you get the benefit of all the processes. You get the benefit of people doing the right things and being productive. And that's where we want to get you to be. So some possible transition vehicles, and I'm just going to throw this out there. So when we're talking about that happy ending, where we're going to, remember we're starting with the end in mind. So I know we're not talking about cash flow. I know we're not talking about ratio analysis and evaluating the company. We're talking about, hey, think about the end in mind first. Hey, you can buy it, sell it. You can actually sell it to your employees now. And that's another good way because it sets aside money for you when you walk out. The employees have already transitioned into ownership by the time you walk out. So it's kind of like a prepaid sale by the time you leave an employee stock ownership plan. You got a private annuity, and this usually happens in families, where money from the company goes into an annuity to pay the owners. Usually a son or daughter will take money, put it into an annuity, and then the parents will draw on it, throughout their retirement, as a way for him to pay for the company, and the parents will get the equity out of it. Then you got joint ventures, right? You can always do things with other companies, that help you get money out of your company as well. So those are the things that we can talk about. If you want to know more about this, Perhaps I'll do another webinar series where we just talk about exit strategies and how to do it. But let's talk about value proposition. First of all, I go back to that main page, right? Value proposition, competitive advantage, marketing. If it starts with a value proposition, this is where we have to talk about, what is a value proposition? All right. And in general, the value proposition for your business is, does my customer get a perceived benefit that is greater than the perceived cost? And it's called perceived because we all have a different thing. How is it? In most cities I go to, they tell me the average cost of a hamburger is like $8, right? So if somebody opens up the menu and it says $8, nobody's surprised by it. But occasionally you walk into a menu or a restaurant with a menu that has a burger for $18, right? Not 18. So it's, over double the cost for just a hamburger. And they're both the same hamburger. I'm telling you, it's just buns. I mean, I've run 3 restaurants, it's just buns, burger, garden stuff. That's about it. That's all you get for the hamburger. How is it that one restaurant can charge 8 and the other one can charge 18? What is it? Well, it's the value proposition. It's the perceived benefit minus perceived cost. When I go into a restaurant that charges me $18 for a hamburger, I also have everything around that hamburger. I've got the waiter with the nice towel over his arm. I've got the ambient lighting, or the very the music that's happening in the background. Everything about it makes me feel like I'm in a special place. So it's okay for it to cost more because I feel like the benefit of the entertainment value of that restaurant is higher than what the cost of the burger is, even though it's the same burger. So let me give you an example, a commercial example using some big companies about a value proposition. And this is where we want to get to. If I just show you, a logo, right? Most people know what the logo that is. I mean, it's just Mercedes, right? Unless I'm in South Dakota and all of a sudden they tell me it's a peace sign. It's not a peace sign. I think a peace sign has one more of these, one more line down. But I'm just kidding. I think that's peace sign. Yeah, I think that's it. But this isn't peace sign, it's Mercedes. Now, for years, Mercedes model for model across the country was the #1 luxury vehicle in total sales on every model. Didn't matter what Mercedes it was the top selling luxury vehicle. There was a car company that came out about 17 years ago, maybe 18 years ago now, that was developed for one purpose, to take down Mercedes as the #1 seller, right? They wanted to sell more than Mercedes. They didn't care about any other driver in the world. If you drove a Ford, if you drove a Chevy, if you drove an Infiniti, they didn't care. If you drove a Mercedes, they wanted you to get out of the Mercedes and into their vehicle. So they built all of their vehicles to the exact same spec, their whole lineup. If there was a 2-door coupe in Mercedes, there's a 2-door coupe in this company. If there's an SUV, then there's an SUV in this other company. Model for model, they were the same. Now, when I throw this up there, some people will throw out words. They'll throw out words about what this means to them. I get words like quality. I get words like expensive. I get words like status, safety. But there's always 1 or 2 words that come up, about what that is. What is Mercedes? These are words that people use to describe it. I always like status because I always think about that. I'm like, okay, if I'm driving down Highway 1 on the California coast or Oregon coast, and I'm in a 500 SL, a little sporty convertible, and a guy in another 500 SL passes me on Highway 1, well, what do you think happens? Yeah, we shoot each other a wave because we're in a club, right? That's where the status comes in. So when I talk about the company, 5 years ago, this new company came into the market specifically to compete against Mercedes, finally outsold them, became the #1 luxury car sales company in the country, and they did it by competing. Again, if they wanted that Mercedes driver, when the guy wanted to upgrade, they wanted to be the competitor to Mercedes, and most of us know who that is. Yeah, it's Lexus, right? And Lexus, we can go side by side and say, yep, it's quality. Yeah, it's still expensive. Status, yep, safety. So why is it that if all of these 4, things are about the same? I mean, we can go down the list. If they're all the same, how did they actually win people over? Well, their total cost of ownership was lower. right? Because one of the things you can do in a Lexus that you can't do in a Mercedes is take it to a Toyota dealership with lower labor rates, lower part rates, and be able to put Toyota parts and Toyota labor costs to it. So the total ownership was actually less. And it actually opened it up to more. If I had problems anywhere in the country, I could go to more than just the Mercedes dealership to be able to get that fixed. So that's one of the reasons why it came around. So they had a competitive advantage in total cost or total ownership. I don't want you to think about price, though, because I don't consider price as being something we should have to compete on. And some people go, and maybe people will raise their hand now and say, I disagree, Mike. I'm in a commodities market, and price totally matters. Yeah, no, it doesn't. I mean, that's just my personal opinion. It probably does in your mind. I don't compete on price, and I'll let you know why in just a second. But here's what I can tell you about you. If you can write down a box right now, just write down a box and put 1, 2, 3, 4 words in it. Doesn't matter. 2 or 3 words that describe you and your company. Here's what I want you to look at. I want you to look at, why should I buy from you? If I can get a car anywhere, if I can get dry cleaning anywhere, if I can get my tires changed anywhere, and I don't know what your business is, it doesn't matter at this point. If you have a competitor in your town, when I talk to bankers, I say, listen, draw a 6-block radius around your office. Are there any other banks there? And most of them say, yeah, there really are. Why should I bank with you, right? It's not the fountain in the lobby. It's not the marble. It's not the cookies or the coffee I get when I come in. There's something about the bank that makes it unique enough for me to say, yeah, I'm going to choose X bank versus Y. Why should I buy your good from you when I can get it anywhere else in town, right? So figure that out. I mean, what would that be? And generally, I get some words that look like this, right? A quality, service, price. I got the best quality. I'm the most trustworthy. I'm the most. It doesn't matter. I mean, it has the best goods. I get the best service, or I got the best price. You can say that, and I say that I don't like to compete on price. Matter of fact, I think out of these 3, even though those are common answers, I think you can only do 2 of them at a time, right? You can have the best quality goods and give the best service, but it's not going to be the cheapest. You can have the cheapest and the best quality, but you're going to get poor service. Or you can have, great quality, great price, and no service. So you can have terrible price and good quality and good service, which means high prices. So I don't think you can do all 3 at once. Now there's a company up here in Seattle that tries to do all 3 of these and almost gets there. All right, almost gets there. And that company to me is Costco. But they've just re-educated us to what service really is, right? If you go into Costco, I mean, I don't think I've ever been helped on the floor, right? Unless someone has got a sample or something like that. Matter of fact, I've almost been backed over by a forklift inside Costco. So what they've taught us about service is, if you want good service, you have to come to my service counter, and there they have excellent service. That funny story about Costco. My grandmother, who's 93 years old now, lives in Orangeville, Illinois. If you don't know where Orangeville, Illinois is, it's a town of about 200 people in west central Illinois, probably 2 hours northeast of St. Louis. 200 years ago, 4 people walked into a cornfield, moved 10 rows of corn, and says, we're in Orangeville. In 200 years, they've doubled in size. That's pretty much what's happened. A few years back, my grandmother ran for mayor, right? I mean, she didn't get beat, but I mean, she did get beat, but she still ran for mayor. Funny thing about my grandmother, once a month, if she needs it or not, she makes a trip 90 miles over to Springfield, Illinois, to the Costco just to buy things. Because in Orangeville, there's no grocery store. They just have a convenience store. 10 miles away in Beardstown, they have it's called a Hy-Vee. They have a grocery store called Hy-Vee, and it's in Beardstown. And then she goes to Costco because she does a thing called, price measurement in her head. She knows the price of every good, it seems like, in every single one of the stores. And if you know anything about my family, when we see a bargain, we buy. Right? That's just what we do. If it's a bargain, we buy it. If not, we probably let it go. So I'm telling you that story because last 4th of July, I went over to my grandmother's house for a barbecue. She always has a barbecue. She said, she said, Michael, can you go get the lighter fluid out of the garage? So I go into the garage. Mind you, she's 93 years old. And on the shelf, there are cans of lighter fluid that are this big, right? Not one or two, there's 6 of them. Right? She bought the big value pack of lighter fluid. Hey, you want to talk about optimistic about barbecuing? It's a 93-year-old with 6 big cans of lighter fluid. So what she had done was she knew how much lighter fluid was at the convenience store. It was like $3.97. I'm just making the prices up. At Hy-Vee, it was like $2.97, but at Costco, it was $1.97. She bought at Costco, but yeah, she had to buy 6 of them, but she bought at Costco just because the price made it. All right, so that's I'm telling you that about Costco just because it's a funny story about my grandmother. More importantly, what is your competitive advantage? Why should people buy from you? All right, here's where I say price doesn't matter. And I'm going to need, we're coming up on 40 minutes. I'm going to need some answers in the chat box, right? Keep me awake here. Keep me going. Keep me motivated. Some answers in the chat box. Here's what I'm going to do. I'm going to show a word on the screen. I'm going to show you a word. And this is me trying to prove to the world that price doesn't matter. When I show the word, what I want you to do is think about what's the most you would pay for this good? What's the most, right? And you can't say, oh, that's dumb, I would never buy that. Somebody in your life needs this product, right? They need it, sweetie needs it, grandma needs it, somebody needs it, and you have to buy it for them, right? So if you wouldn't buy it yourself, what's the most you would pay for somebody else, all right? And just write it down. And that's all I want you to do is write down what's the most. You have to buy it, what's the most you'd pay. So here's the first one, how about a bike, right? Go ahead and type in the chat box, some numbers. How much did you pay for a bike? All right. So right now I've got 150. Can I get a few others? Anybody got one? Anybody lower than 150? Oh, they're in the questions? All right. Let me open up questions. Oh, my. There we go. Okay, I see it. Yeah, it's harder to read for me in the questions. All right, so you got 150, 240, 150. Goodness. Show answered questions. Yeah, they're a lot harder for me to read there. 150, 500, 250, 100, 350, 200, 1250. So it looks like I'm seeing anywhere between 150. Oh, no, there's 100. I always say that $100 bike, is that a brand new bike? It's not like a garage sale bike or something, is it? Just kidding you. Anyway, so it looks like we're anywhere between 100 and I don't even want to write a number that big. Somebody wrote 4150. Hey, no motor, right? That doesn't have a motor on it, right? That's just a bicycle. Okay. All right, there we go. What about, here's the second one. A bottle of wine. What's the most you would pay for a bottle of wine? All right, let's do that one. Bottle of wine. Go ahead and write that in there. Oh, somebody said 4 was supposed to be a dollar sign. Okay, well, there was a 1250. I'll change it to 1250. Or 1250. Yeah, it's real hard to see. I got like 2 inches. All right, 65, 20, 80, 30 to 40, 50, 50, maybe 100. All right, so what's the lowest one I saw there? I got a 30, a 20. Nobody's buying a $2 chuck? So I did that. So I got 20. Where's the chat box? It's right underneath the questions. I think it'd be easier for me to see in the chat box. But maybe I can pop this out. Undock from. Oh, that's a lot better. Okay, I found a way to see this a lot better. A lot easier. You can stay in questions if you want. All right, so 20 to maybe 100. Kelly, I want to party with you if you're buying a $100 bottle of wine. How do I move this? All right, so we got $20 to $100. All right, the next one is going to get some guys in trouble, so be real careful. How much would you pay for a purse? Just a purse. And this one, when I've done this one in LA and some other places, oh my goodness, those numbers get outrageous. Let's see here. About a $15.99, I guess, in there. So a purse. Now I'm getting things like 500, 200. Is $15.99? Is that for the? Is that for a purse or for a bottle of wine? So I'm thinking 500 might be the largest. It's pretty good. $20. Okay, wine. Got it. $15.99 on the wine. So let me change that. $16. All right, so we're anywhere between $20 on the purse, Kim, or wine? Yes. Yes, she says yes. A purse. Okay, that's not like one of those Trader Joe's cloth bags you get, right? 125 on the purse. So I got 500. Kelly is spending all kinds of money. $500 on the purse. Now, Kelly, you do realize that the money goes in the purse, right? Okay. All right. Walmart. Kim gets her purse at Walmart. Okay, got it. All right, so 2,500. All right, here's the last one. A candle. I know, Kelly. I know. The most you'd spend. And that's actually, I've seen thousands on that before. When I've asked the same question, I've seen thousands. All right, so a candle, we got Bonnie at 20, 10, 12. Who's buying those Yankee Doodles? That's right. That's right, Kelly. There you go. $1. Somebody's buying one birthday candle. Jody said, I'm not spending money on candles. $1. We got 4. There's one of those Yankee Doodle Scentsy candles right there. That 45. Kelly again. Kelly, man, she likes to spend money. Okay, there we go. So, what's the point? All right, that's what I'm trying to get you here. You know, what's the point? If you look at us, we're a small group. All right, we're kind of a small group. We're just here together. But look at how all of us responded, right? I mean, look how all of us responded, 100 to 1250. There's a gap between all of it. What that's telling you is that there is a market at every price point. All right, so what you've got to do is figure out where you want to compete at on that price point. But I could put up any number of words there, of products or services, and we all have a market within what we'd spend on the most side, the high side, or on the low side. So that's what the point is there. That's why I always say price doesn't matter. I can do this exercise across the country 100 times a year. It comes out the same. There's always that spread. So don't get wrapped up on price. We're going to talk about how to price your goods. Don't get wrapped up on it. You price your goods to run your business, right? You've got to price them to where you're getting enough money and enough value out of it. So this is just some information about business facts and financial management. And we'll talk about that. One of the things I want to point out on the business facts is just the types of businesses that are out there: service, retail, construction, wholesale, manufacturing. Those are the ones. The main ones are again here: service, retail, construction, contracting, wholesale, and manufacturing. Wholesale and manufacturing are kind of the same. Believe it or not, they have some of the same limitations. Usually, the limitations in a wholesale or manufacturing company are around space. Meaning you can only produce so many goods in an amount of space, and that usually comes down to a revenue size, right? And usually around $7 million when they kind of hit the wall and they need to grow. Construction, usually when they got 3 jobs, their limitations around 3 for 3 jobs, and they have to grow, hire more people, hire more team, hire more management. Retail, It's about location, right? You can only generate so many sales in a certain amount of square foot. So in order to grow in the retail business, you either got to expand your store or open another location. In the service industry, it's about number of employees, right? Number of employees, meaning that the magic number is 7, right? Once you get past 7, you need more management. You need to figure something out. In my hotel staffing company, I actually got away with 15, right? I can manage 15 at a time instead of 7 because we weren't managing their actual work product. We were more a recruiting agency. So I had one supervisor manage 15 employees, just making sure they got to work and the order was filled. Okay. So we'll talk about some of the things about poor financial management. We're going to talk about becoming a financial doctor, which means testing, analyzing, diagnosing, and prescribing a solution. We're going to be able to develop a plan by the end of this and be able to grow and look at break even. And then again, throughout, we're going to talk about dealing with the bank, right? So by the end of the 6 weeks, you're going to have the answers to the banking test, where if you're looking for a loan, you don't have to be looking for a loan to think about this. But if you're looking for a loan, you're going to be in good shape, right? What I'll say by that is that most people, when they go in, look for a loan, and I've seen it happen because I work with bankers. I hear the stories all the time, which is somebody comes in, a business owner walks in and says, "Hey, Mr. Banker, I need a loan." And the banker goes, "Okay, how much do you need?" And the most common answer from the business owner is, "I don't know, how much you give me." Well, that's the first indication you don't know what you're doing, right? If you got to ask the bank how much they'll give you, which means you don't know how to run your own business. So by the end, right, and actually it'll probably come up next week. When it comes up next week, you'll be able to start to determine, are you in good financial health? Can you get a loan? And then how much can I get, right? I want you to be able to walk in and say, "I need X amount because this is the way my business runs," and be able to explain it. Part of getting a loan is showing to the guy, the banker, who actually has to go into a loan committee and sell your company to the loan committee, is them understanding whether or not you understand how to run your business. All right. From a banker's perspective, all right, or from a business owner's perspective to a banker, it used to be that you couldn't start a business, a small business like we do, if you didn't have 3 people kind of on your team or on your side, or you knew who they were. You needed, and I'll just say they were on a pedestal with the business owners. You in the middle, and you had your accountant, you had your banker, and you had your attorney. All 4 of you guys set up your business and started running it. After 2007, 2008, the banker fell off the map, right? Stopped talking to us. They burnt the world down. They fell off the pedestal. And I've been asking people for the last, 20 years, right? I'll say 20 years because that's about when I started in business, is who do you ask for advice? Who do you go ask, right? And if you want to, just put it in the chat box or the question box. Who do you ask for advice? And I'll do this because I compile these. But here's what's happened over the last, I'll say 10 years since the banking crisis. They fell off. Bankers are now still in the top 10, but not in the top 3. The banker is actually ranked 7th, right, behind other. So, if I just look at everybody else, people are going to the bar and talking to Joe next door and say, "Hey, Joe, let me tell you about my business. See if you got any ideas," rather than going to the banker. So what we want to do is try to help you have a conversation back with them, because they are the ones that can help fuel the growth of small business economy. After this course, you might not need them, but if you do need them, you understand how to work with them. Okay, here's your homework. We're coming up on the hour. Here's your homework for week 2. All right, and that's kind of how I'll run this. Is I'll try to leave you at the end of the week with some homework for the next time we come back. I want you to work on the next 2 pages here, which is I can't see the bottom of the screen to know, but business math. There are 9 questions. All right, 1-5. There's 9 questions. Answer those 9 questions for next week. All right, that's what you're here to do. So when you work down through them, just have those answers. That's the first thing that we'll go through when we get back together. And if you notice, I'm just starting. I teased you with why we're doing things. Now we're going to get into the how you do things. So the why is that we want to run a successful business that has less risk, right? And if you think about it, if you're thinking about getting out of your business in the next 5 to 7 years, it's really important, because the next 5 to 7 years have been labeled what's called the Great Generational Transformation. It's PricewaterhouseCoopers did a white paper on this, and they called it the Great Generational Transformation because the baby boomers will be exiting the market, which means that 75% of all small businesses will change hands in the next 5 to 7 years. That's important. If you want to exit your business in the next 5 to 7 years, you got to know that so is everyone else, right? Everyone else is going to be doing it. That means that there's going to be a flood of businesses on the market. If you want to get the best value, if you want to be the shiniest object, you need to understand how to run your business today so you look like the best value on the market tomorrow, right? So that's what we're going to be working towards is how do I run it today for the best value tomorrow? And the way you do that is back on, and see if I can go back to it. We're going to focus on this slide right here. That one. This slide right here, where it's profit, potential, people, process, and products. This is where you make all your money. This is where somebody decides that you're worth it. All right. This is where risk is. All right. If you're the type of owner, right? If you're the type of owner who can't leave their business, or you can't leave your business without something catching on fire, without your phone blowing up the whole time you're away, without without any type of peace, you don't have the right, probably either process or people in place. There's something wrong, right? That's what it tells you. And if I'm as a buyer, or anyone as a buyer is looking at your company and I see that's the way your lifestyle is, I'm not going to buy into that. I'm not going to buy your problem, right? And if I do, I'm going to pay a lot less. I'm like going, there's a lot of work there to fix this thing. I don't want to have the lifestyle that they do. They can't go on vacation. They can't, I have people say they can't even spend an hour on a webinar like this because there's too much going on in their business. That means they don't have the right people in place to help them, and where they can't get away for an hour, or the way they're doing it is poor too. You got to remember, out of businesses, 8 out of 10 fail, right? 8 out of 10 businesses fail. That number drops to 4 out of 10 for a franchise. It's less than 1 out of 10 for McDonald's. If you're thinking like me, you're like, oh, why is that? How does a McDonald's, stay the way it is? A movie came out called The Founder. It told us the exact way it happens. It's all process. It doesn't matter about the person that's there. It's the way it's set up. It's the way the process is. I can put the right people in, work the right process, and guess what? I'm going to pay higher for something that works efficiently, where I can treat it like a machine, because that's what it is. It's a cash machine for you. It's designed to put cash in your pocket. Let the gears happen. Let the gears work. That's what we want to get to, is how do we build our process and put the right people in place? If your building catches on fire every time you go on vacation, we're doing something wrong, folks. We're doing something wrong, so please let me help you. So coming up on that hour, your homework is to do 1-5. If you look at the bottom of the slides, 1-5, it's business math. We're going to start exercising the math muscle, and we'll come back next week and do those together. So Chris, I'm going to turn it back over to you for closing comments. Maybe put in a plug for next week's episode, and I'll let you guys go.
Awesome. Thank you very much, Mike, and thank you everybody else for participating and making sure Mike doesn't fall asleep. We definitely appreciate that. I will follow up with an email to everybody so that you have my contact info, and if you did not get a copy of the PowerPoint, or if you have any questions, feel free to reach out to me directly, and I will make sure that I get you taken care of. So again, thank you, Mike, and thank you all, and have a great rest of your day.
Thanks, guys. See you next time.